Good afternoon, everyone, and welcome. I'm Shauna Fleischbein with Castle Group Property Management. If you're not familiar with Castle, we are a full-service association management company across the state of Florida. We specialize in full-time on-site communities, both HOA and condominiums. So if you guys should need anything, please don't hesitate in reaching out to us. And today I'm joined by George Root. George, would you like to introduce yourself and your firm?
Sure. My name is George Root. I'm a general counsel attorney for condos and HOAs all over Florida. We have offices in Sarasota, Fort Lauderdale, and Tampa. I've been doing this about 11 years, and my firm does first-party property stuff. We represent the HOAs and homeowners in insurance disputes, whether it's a denied claim or not full coverage, that kind of thing. We also have one PI attorney, but I'm the general counsel, and that involves everything from violation enforcement, collections, opinion letters, you name it. I'm your first stop for all your general counsel needs for condo and HOA.
Fantastic. So we're going to jump right in here today. We're all trying to start healing and revamping from what we've dealt with over the past year plus with COVID, and our boards have dealt with a lot with policies and procedures and what to do and what not to do, and it's been a tough year. As if being a board member is not tough enough, any other normal year have COVID, have a international pandemic thrown at you, and so part of that, of course, is the moratorium and with foreclosures and all of that good stuff on mortgages. So here in Florida, that was lifted quite a while ago now, but we still have we still are dealing with it from a national, federal level. So we're gonna let you kind of walk us through that, George, where we're at, what the future holds, how our associations can prepare for when the moratorium is lifted. So we'll jump in, and just a reminder to anybody who might not have joined us, on an ongoing basis, or might be new to our webinars. We will send out emails before the end of the week that will have a link to this webinar that you can go back and view, or you can forward to other board members or committee members. And we'll also send you, George's information. But feel free to submit questions throughout, and then we'll also have some time at the end, I'm sure. So, George, I'm going to hand it over to your expertise.
Thank you, Shauna. Thank you for having me. It's a pleasure to be here, and I appreciate the opportunity. And I hope that I can provide some useful knowledge for folks out there. One of the things I would encourage every association to do, if they have not already done so, is work with their general counsel to create and adopt a collection policy. It's important to have those in place so that you don't have to have a board meeting every time a file fits in the policy. I mean, that's part of the policy to help you, number one, treat everyone equally and not have a selective enforcement or waiver issue. And it also streamlines the process so that when a delinquent file hits a certain threshold, whether it's 30, 45 days, whatever the case may be, management knows what to do. They send their friendly reminder letters, and then at some point they send it to the attorney for action. So that having the policy in place helps you avoid having a board meeting every time you need to decide whether to send a file to collection. So if you already have a collection policy, you may want to review that with your general counsel just to make sure it's up to date and it's statutorily compliant. For example, the recent statutory changes have implemented for condos a 45-day notice period instead of a 30-day period. They are also requiring friendly reminder letters from management that are mandatory prior to sending it to an attorney. Beforehand, it wasn't necessarily a statutory requirement, although in practice, all great management companies like Castle were doing that kind of thing anyway. I find, as someone who does a lot of association collection work, that it's a lot easier to get it resolved, and I have less of a fight on my hand if I can show them that we've sent coupons out, friendly reminder letters, ample notice before it ever came to me. People are reticent to pay fees and costs if the first time they're hearing about a debt is when they get an attorney letter. So adopt a collection policy. You can certainly grant exceptions in certain circumstances. You may want to think about those in advance, i.e., we're willing to do 6-month payment plans. We're willing to waive late fees and interest in exchange for a lump sum payment in full. Those are the type of things that you're going to think about in advance and maybe make a part of your collection policy as well. Your general counsel will probably have several sample collection policies for you to review and tailor to your circumstances in your association. And you're also going to want to make sure, if management provides you a collection policy template, that the requirements in your policy meet the requirements in your governing documents. Your governing documents may have additional requirements and strictures that the statute doesn't necessarily require. So your statute's going to have bare minimum rules that you have to follow, but you could have more stringent notice requirements in your governing documents. So those are the type of things you want to sit down with your general counsel and work through and make sure your policy meets all statutory governing document requirements, and also streamlines the process for you. This is trying to eliminate your need to have a board meeting all the time to discuss these issues.
Yeah, and George, I'd like to add to that. So yeah, that is our standard policy, at least at Castle, is that we work with our associations if they don't already have a policy in place. And again, like you said, look at your documents. We help them draft something, but it also needs to go to the attorney for attorney's blessing in the end. We're happy to help them draft it and make sure, that they're following statutory regulations, but also their documents. But in the end, it's really important that really any major policy like that, you do have your attorney's approval. You let them, give their blessing on it in the end before you actually, start using it. And I know our policy is, have a policy, because you don't want to. So many times we speak to boards and they're like, well, boards in the past gave exceptions and they gave this person an exception, but then this person wanted exception, but then they didn't give this person an exception. And yes, there are times for exceptions, but just like covenants enforcement, you need to try to, be as follow the policy as much as possible. And then, yes, you will make those exceptions, but you can't make it a trend to make an exception always, because otherwise there's no point in having the policy, right?
Absolutely. And in adopting the collection policies, all of your governing documents are going to have, more than likely, most of the ones I've ever seen, give the board the authority to promulgate rules and regulations. So that's where your ability to adopt the collection policy comes from. And I've also seen some folks that'll adopt the policy and it's an in-house document. I've seen other associations draft a recordable resolution to file in official records. And if you get to that point, we can kind of discuss with your general counsel, can discuss with you to figure out whether you want to do it in recordable form and that kind of thing. But you definitely need a collection policy. Shauna was talking about the first mortgage foreclosure moratorium, the federal one that goes through the end of July now. We did have a state one in place for a while, but I believe it expired last October, sometime around then. It's been out of play for a while. And each state had their own version of a moratorium, and it could be more expansive than what the federal one was, and that kind of thing. But the Florida lifted theirs quite some time ago, and now the federally backed mortgages, that moratorium applies just to like FHA loans, VA loans, those type of similar federally backed loans. And I do think that it will be lifted in July. So this class is very timely. I started out as an attorney back in 2009, 2010 timeframe, back at the height of the first mortgage foreclosure crisis back then, and gained a lot of experience during that time doing collection and foreclosure work and understanding how to combat some of that stuff. So I'm going to help my clients implement that stuff going forward so that it doesn't impact them the same way that it did back then. One of the things that I've learned is that you're going to need to take a look at your budgets and make sure that you have the appropriate legal budget to handle these type of things. And this isn't just a self-serving statement on my part. Most of my competitors, peer groups, they all do the collections work on a contingent basis. So if they don't recover from the owner, they write off their time on those cases. However, most attorneys are still going to want to be reimbursed for the court costs that they shell out. and most of the assessment lien foreclosures are around $600 at least. So you need to be prepared that there's going to be more collections. You're going to have that money. You will probably ultimately get it reimbursed via the collection process. However, you still have to have those funds up front to cover the cost of litigation. In addition to the assessment lien foreclosures and collection processes that you're going to be doing yourself, you're also going to have to respond to first mortgage foreclosures as a junior lien holder. So you will need a little bit of money to handle the answering of those foreclosures. And most of my competitor firms, peer groups, charge an hour or less to answer the first mortgage foreclosure and monitor the case from beginning to end without further charge. So it's not a huge amount, but if a quarter of your community goes into foreclosure, it can add up in a hurry. So you want to take a look, work with management and your general counsel to make sure that your legal budget's adequate to cover those expenses. And like I said, if you do it right, you will be able to recover a large amount of those funds from the delinquent owner or the bank when they take title, if you do it right.
Yeah, and we don't have a magic ball, obviously. We don't know, even if you look at the housing market right now, everybody's asking like, when's this bubble going to burst, this and that, and even, realtors are like, this is kind of a different scenario. We don't know what the future is going to bring, because the mortgages, the lending, all that's not being done like it was way back in 2007 and all of that when that happened. So I know we don't have a magic ball, but do you have any kind of percentage, any kind of formula or anything like that you would suggest or guide boards, or is it really something that they just have to look at their trends from the past and kind of figure it out based on that?
Well, there's some things that I know as a certainty. There have been very few, if any, foreclosure filings in the last 15, 16 months. And it looks like it'll go on for a couple of more months. So there's an there's a backlog. Even in the best of economic times, there's a certain percentage of foreclosures that get filed every year. So now you've got 15 months worth of that normal percentage, plus an added percentage of those impacted by COVID that have been taking advantage of the moratorium and have defaulted on their mortgages without reaching agreement with the bank. So there's going to be a lot of filings as soon as the moratorium is lifted, and that can't help but have some impact on your accounts receivables and the economy as a whole, especially like the real estate pricing. It will take a while, I think, to feel the full effects, because once you file the foreclosure, even one that's lightly contested could last at least a year, lightly or not contested at all. And if the dockets are clogged, that slows the process up as well. So, it's hard to tell exactly when you will feel the impact. And maybe you're a community where folks are fairly affluent and have saved well and don't have any issues. But even in those communities, you still have a normal percentage of foreclosures every year you have to deal with. And so you're basically going to get 2 years worth of foreclosures happening at once. The biggest mantra I always tell clients with collection in general, even when there's not a moratorium and pandemic affecting your association, is take early action. Some folks don't want to start a collection action because the amount in controversy is so small, or the annual assessment's only a couple of $100 or whatever the case may be. But the longer you wait to take action, the greater the chance that you're going to have bad debt write-off. Get your intent to lien letters out there, get it lien to protect your priority. And, arguably, especially in condo world, your liens are only good for a year, and you're going to have statute of limitations issues if you don't attack this early. At the outside, 5 years is the longest you're going to be able to go without foreclosing on a lien and still have a right to collect it. So the longer you go, you jeopardize your right to make a full recovery and or ability to. So always take early action. If you have good general counsel and good management, they're going to understand that. I do my fees on a contingent basis, and I'll gladly take a haircut on my fees if it means that you're getting most of your principal back. I don't mind taking less if it means you get bigger chunk of your principal. So take early action, be willing to make some concessions. The old adage, a bird at hand and worth two in the bush, is totally true. You don't want to push the person into bankruptcy or first mortgage foreclosure if you can avoid it. Sometimes it's unavoidable, but you don't want to take such a hard line that you get a zero instead of recovering most of your hard debt. Soft costs are I'd readily waive or reduce to incentivize a short-term payment plan or a lump sum payment in full.
And speaking of, foreclosures and we had a question come in, what is the typical timeline for moving foreclosures through the system? Is it kind of all over the place, or is there an average?
Well, I'll start by distinguishing an association action to collect its debt versus a first mortgage foreclosure action. The assessment lien foreclosures that I file on behalf of the association are usually in county court if the amount in controversy is relatively low, which almost all of them are, and there's less red tape and hoops and hurdles to jump through and over. So you can, if it's lightly contested or a default, sometimes I can get it to a foreclosure sale in 6 to 8 months. So you can move it through the system a lot quicker, the assessment lien foreclosure. And out of all the collection files I start and, assessment lien foreclosures that I eventually file, very few actually go to the foreclosure sale. Most of them are resolved well in advance of that, lump sum payment in full, short-term payment plan. Only a very small percentage go to a foreclosure sale. And the vast majority of the ones that go to foreclosure sale, if you start it early, you'll have a third-party investor pay off the judgment and you get paid in full. Very few of them become association owned. So with assessment lien foreclosures, you can easily get it resolved in 6 months to a year. Most of them do. With the bank foreclosures, it's a crapshoot. You really don't know how long it's going to take. If the amount in controversy is not that high, then it doesn't impact you the same way that a condo that has $400 monthly assessments is impacted by a long foreclosure. Sometimes I can take actions for a client to speed the process up. If I see the bank not being aggressive with its action, sometimes clients pay me to file a motion to get case management deadlines or otherwise set deadlines to speed the process up. Sometimes we can file motions to reset foreclosure sales. It's hard to give you a set concrete deadline on a first mortgage foreclosure, though. I've had ones that get resolved in a year or two. I had one that was on the books for a decade. If you stay after it, though, you can move them along much quicker. I think that answers the question, but it's harder to give a concrete timeline on the first mortgage foreclosures because you're up in circuit court. There's greater rules, more rules. There's federal mandates as well that kind of dictate and make it harder to, move through that system as quick.
Okay, perfect. So where were we at? We took early action. So avoiding bankruptcy and first mortgage foreclosure. Is that where we left off on our agenda?
I think this is a good time to mention that that you should answer all your first mortgage foreclosures. I have some clients that want to save money and they don't have their attorneys answer the first mortgage foreclosures and they let the association get defaulted in the action. And I don't think that's ever a good idea. And I'm not just saying that from me having an opportunity to bill for doing work, but the charge for, most of the firms is an hour or less. And that gives you the opportunity to file motions in the case to speed it up. It keeps you apprised of what's going on in that case. You're going to know about surplus funds after a foreclosure sale right away and be able to make your claim. In order to take any action in the case, you have to be a party to the case, and your attorney files a notice of appearance and answer to the foreclosure, a claim to any surplus, and that kind of thing. And almost every firm out there answers it and monitors the whole process for an hour or less. So it's totally worth doing. I think you need to do it. And here's the thing, in most of your governing documents, if you read them carefully and you have strong specific assessment rights, there's a good chance that you can recoup those costs from the delinquent owner as a part of the collection process, the estoppel process. when title changes hands, whether it's via short sale or a first mortgage foreclosure. So answer them. It's not that expensive considering the benefit you get from them. And if you do it right, you can get that money back from the delinquent owner or the bank eventually anyway. Another way to collect on delinquent debt, keep periodically, some of you have transfer and lease approval clauses in your governing documents. If you do, you've got a good idea. You know exactly which units have tenants in them. If you don't know which units have tenants, you probably need to informally do an inspection occasionally and have an idea or a roster of which units you think are tenant occupied. Because if those units ever become delinquent, as part of the collection process, I can, or your general counsel can send a tenant demand letter to the delinquent tenant and copy the owner, and essentially allows you to commandeer their rent until you've collected enough to pay off the debt to the association. And, you know, one thing that you're probably aware of, if you've been on the board for a while, you often cannot lien for certain fines, depending on whether you're a condo or HOA. Sometimes fines are unlienable if they don't hit $1,000 or if you don't have lien rights. So with the tenant demand process, the way the statute's worded and the way I interpret it, you can collect any monetary obligation owed to the association, whether you have the lien right or not. So that tenant demand process can be very valuable to you. And if the tenant or the owner ignore the tenant demand, then you can send an eviction notice via mail, certified regular mail, and also post it on the door. Very rarely do I take the extra step of filing the eviction action, but in most cases, just the initial demand letter or the eviction notice prompts action on part of the tenant or the owner and gets a settlement of the matter.
Yeah, and I mean, it's a great practice anyway to know who your residents are, not your owners. I mean, obviously you want to know who your owners are, but you want to know who your residents are, especially in condominiums. You know, if you need to send out some type of notice, you need to, you know, there's an emergency, whatever it might be, you really want to try to have contact information for whoever it is that's residing in the unit. So, I mean, that's a good practice anyway to, you know, have something. Obviously your docs sometimes, you know, regulate whether or not you can do background checks and things of that nature, but to at least have some type of process in place to know when you have renters in your units or your homes, because you want to be able to have proper contact information for anybody who's residing in your community. So and then of course it becomes much more beneficial when something happens and you want to you know, your owner becomes delinquent, you know, it helps you in that regard as well. And we did have a question that came in. If you have a relative who's residing in a condo, so this is condo, relative who's residing there, they never pay, this association constantly has to go to the owner, who I guess is an uncle. So in that case, I mean, that's what you do. If it's not a legal renter and you know, you don't have a lease or there's no lease involved, I mean, you would just continue to go after the owner, correct?
Right. I mean, the owner is the one contractually obligated with the association to pay assessments. And for those of you that are unfamiliar with the inner workings of the process, essentially associations created by a developer, they record all your governing documents. In those governing documents, they're essentially a contract with anybody that moves into that neighborhood after they're recorded. And they have lien subordination clauses and assessment lien right clauses in there, which basically you're agreeing to pay the association assessments to help maintain the association. And that contract's between the association and the owner, not the association, any tenants. Now, any tenants that live there have to abide by the restrictions, but they aren't contractually obligated to pay the debt attributable to the property. And this is probably a good time for me to jump in and explain in rem versus in personam property concepts. Those are just Latin words. In rem essentially means against the property, and in personam means against the person. So when assessments accrue against a property, whoever lives there at the time the assessment accrues is personally liable for that debt. And the debt also travels in rem with the property even after that person transfers the property. Let's say somebody quitclaimed the property to someone else without paying the debt. The original owner is responsible for all the debt that accrued up to the point they took title. That next owner is going to be personally liable for all the debt that accrues from the day they took title forward. However, there's going to be an in-rem liability against the land as well. So the land's liable and the person's liable, and that comes into play when you have people filing bankruptcies, and also first mortgage foreclosures. Sometimes people, I mean, it's a pretty nuanced discussion, but I just kind of want to give everyone the baseline of in rem versus in personam. Sometimes people can have their personal liability discharged in a Chapter 7 or a Chapter 13 bankruptcy, but maybe you can still collect on an in rem theory against the land or the next owner. So those are concepts you can get into more depth with if you're faced with those situations. And that's why I encourage clients to make some concessions, reasonable concessions. I very rarely recommend waiving hard costs, except for in very dire circumstances. But you know, if I can write off some attorney's fees and the client's willing to write off or reduce some late fees and interest to avoid pushing somebody into bankruptcy and having a greater, you know, write-off, then I'll do that every day of the week. The big thing is be consistent with your approach. I certainly don't like granting payment plans longer than 6 months, but in the same vein, part of my job is to collect as much money as from these folks as I can to reduce the bad debt write-off, especially if I know that there's a possible bankruptcy out there or a first mortgage foreclosure pending that's going to wipe out some debt. One of the things I mentioned earlier is a lien subordination clause in your governing documents. So when you file your governing documents, your developer does, and creates the association, you have lien priority over anything else that gets filed of record in that association afterwards. So if there were not a lien subordination clause added to that declaration, lend money in your association, because then the association could take their collateral for a couple $1,000s that they're owed. So they started creating these lien subordination clauses in the governing documents, and they essentially say, dear bank, please lend money here. If you're a first mortgage of record, our assessment lien will be subordinate to your first mortgage lien. And so when a bank forecloses, it generally wipes out your right to collect that debt against that property. You could, the in rem liability, you could still go for an in personam action against the person who racked up the debt. But a lot of times you don't want to do that because they don't have anything to go after. If they've lost their collateral in the property, they probably don't have assets. If they did, they probably would not have been in that situation to begin with. So a lot of times associations do not pursue in personam actions once they've lost the ability to go after the land in rem.
So we have a couple other questions that came in, and this is kind of going back to the moratorium, you know, specifically that topic. So we have two that kind of somewhat can go hand in hand. So I'll just kind of give them both. So one is, should the current policies be adjusted at all for the current events, you know, that have been going on for the past little over a year? And then the other question is, should letters be sent out before or after the moratorium is lifted?
If you're adopting a policy for the first time, yes, you should put it out to the membership and make sure they all get a copy of it. It's going to be much easier, and you're going to have a better argument for enforcing your policy if you put everybody on notice that there is a policy and here's what it is. Yes, you may want to send a notice out to owners and say, hey, I think it depends on what your ARs look like now. But you could preemptively send a notice out to the owners, essentially saying, we know some of you may be struggling. We know that when the moratorium is lifted, that it may create financial problems for you and create an inability to meet your assessment obligation. If you're in one of these situations, please preemptively reach out to us so that we can figure something out to help you. You're obviously going to want to give them the chance to come to you first, so that they can avoid attorney's fees and costs, interest, late fees, things that'll make the debt even harder for them to get a handle on. So yes, it may be a good idea to send notice of the policy or the moratorium lifting and that kind of thing to owners to kind of prepare them for what's coming.
Okay. And then going back to just, obviously the two go hand in hand, the moratorium along with your standard collection, policies. So can you walk us through, I had a few questions that came in regarding, what happens if, residents don't pay delinquencies after sufficient notice, and, the process for lien on a property for non-payment. So can you kind of walk us through, obviously it differs, association,
Right.
but your typical point A to point Z process for collections, from the first, late letter to whatever foreclosure, can you walk us through kind of the typical steps of that process?
Generally, you have your budget meeting every year. You adopt your budget, you figure out what the proportionate share is for all the owners, and then management sends out your annual coupons, lets everybody know the frequency and the amount of assessments. And generally, if someone doesn't pay on time, it's designated that they're late after a certain number of days in their governing documents, what have you. Then management will send out 1 or 2 friendly reminder letters before sending it to the attorney. Once it gets to our office, we send an intent to lien demand letter, 45-day pre-lien letter, and then we send a proposed lien at the expiration of those 45 days to the client to execute. It used to be 30 days for condos. On July 1st, it's going to change to 45 days notice. So I've started doing 45 days notice on everything. You're never going to get in trouble for giving more notice than is required. Giving less notice is where you get into trouble. So after you send the intent to lien letter, 45 days, if they haven't paid, haven't reached a settlement agreement with you, you can execute and record a lien of record in your county official records. And even if you don't have the stomach or desire to file an assessment lien foreclosure, eventually I encourage you to file the lien to protect your lien rights and your first in time rights, that kind of thing. You want to perfect your lien rights and let everybody out there know that you're there. And it's not that costly to do it. Most firms charge just the recording costs. It's $28 maybe at most to record the lien. Your firm, your general counsel firm, should be doing the attorney fee work on a contingent basis. So up to that point, to get it liened, you essentially only spend $28. Once you get it liened, you have to send a second demand letter, 45-day demand letter out, a pre-foreclosure demand letter, letting the homeowner know that if they don't resolve it within 45 days, you have the right to file an assessment lien foreclosure. At the expiration of that second 45-day period, I do an informal title search. I take a look at the file, I get an updated ledger, review the file, and then I'll send a letter to the client making a recommendation on whether to file an assessment lien foreclosure or not. And so I'm doing a bankruptcy search, I'm doing a first mortgage foreclosure search, and trying to determine whether it's a good recommendation to file an assessment lien foreclosure. And the main things I'm looking at is, will this put pressure on the owner to pay? Do we have a chance to finish it quickly enough to make it enticing to an investor? And if they purchase it at the sale, it would pay off our judgment. Those are some of the things I'm taking into consideration when I'm making a recommendation. If the client asks me to go ahead and file the assessment lien foreclosure, we file the complaint and then we serve it on any tenants and residents, and then the owner, if they're not resident property occupied, then we have to do a skip trace and figure out where they're at and get them served at the other property. Once we serve the owners and the tenants, they essentially have 20 days to answer the complaint or file a motion to dismiss or otherwise. If they don't, you can have them defaulted, and then you can really streamline the process. Probably half of the complaints I file aren't answered. If an owner is walking away from the property eventually, they may not bother to hire an attorney or answer the complaint. And even those that do answer, a good portion of them are pro se. They don't hire an attorney. So after the 20 days, you can default them. If they answer it, then you can move on to the motion for summary judgment stage, and you file the motion and affidavit showing how much you're owed and that kind of thing, and set it for hearing. Once you get that hearing, you're asking the judge to grant you a final judgment saying how much you're owed and to set a sale date within 30, 45 days. And you advertise the sale, and then at the sale, bidders, third parties bid on the judgment, which is usually only a couple of $1,000s. Sometimes it's more than that for condos with high monthly assessments. But that's the process generally. If it's lightly contested, you can get to the foreclosure sale in 6 to 8 months.
Okay, perfect. So hopefully that was helpful to those few people who kind of asked for an overview. I did have a question come in earlier because I opened a bit of a little can of worms here when we're talking about the tenants and all of that. So Liz had asked, or had mentioned they have some owners, tenants, but the owner is a company. It seems to be more challenging to get information from them. So, yes, we have a lot of condos and HOAs out there that have investment companies, who own those units or those homes, and it does become more difficult, to deal with them, not only from a payment standpoint and an informational standpoint as far as the tenant, but even ARC, compliance. So from my experience as a CAM, throughout my time in this industry is look at your docs, number one, because a lot of times the documents do require that owner submit a copy of the lease to the association. So that's number one. So if your docs do state that, obviously, try to follow that rule. That'll help you get information on your tenant as well. Like I mentioned before, and George, obviously I'm not an attorney, but you can, add to this is some associations, the documents do allow you to do background checks. So that can, you can have a requirement. Obviously, it becomes much more easier for associations that have some type of access control, whether that's a front gate to the association or to the community, or you need to have a fob or a code or something to get into amenities, because you need to know they need to kind of come through you to get that information. So it makes it much easier for associations who have that, especially if there's a gate, becomes much more easier to require them to give you that information. But do you have any other, any other tidbits to add to that, George, and kind of how to manage that as far as getting tenant information from, especially those that are owned by investors or companies?
Well, like you said, if there's a tenant approval process, transfer approval process, those kind of things, you can, if they don't provide the documents that are required by the governing documents, you can certainly send violation letters and pursue them that way. And why I'm thinking about it, I mentioned bankruptcies earlier. If one reason it's important to keep track of which units are in bankruptcy is I can't proceed with any collection action or a violation action, or shouldn't send any of those type of letters to the owners if there's a bankruptcy stay in place. I just want to mention that while I remembered it. But there's a number of ways to get creative with tenants and to put pressure on owners to do what's right, whether it's to pay what's owed or quit violating. There's a lot you can do to put pressure on the owner by sending letters to tenants. And anytime we file an assessment lien foreclosure or send a demand letter, we're copying both the owner and the tenant. And between the two of them, that the whole thing's about applying pressure in a way that gets results that you're looking for. And vast majority of tenants are good performing tenants, and they want to stay where they're at. And so they're going to sometimes be your partner in getting compliance out of the owner, and vice versa. Owners don't want to take on that extra financial liability due to their tenants' actions, so they will be your partner in curbing the behaviors of the tenant. So and one of the other reasons that we name the tenants and everything is, especially in like foreclosures, if you're going to take title and possession of a unit, anybody that's possessing that unit has to be on notice of what's pending as well.
So what advice do you have for a newly turned over association? In this case, it's not a 55 up community, because I know in a lot of cases that probably will play a part in, especially the moratorium, because my best guess is that, those who are in more of the retirement phase, may not have been quite as affected by the COVID, the pandemic, as those who are, working and in the workforce and may have lost jobs and things of that nature. So this is not a 55 plus community. They're trying to budget for next year, for 2022. And this is, like I said, they just newly turned over. So this is new for them as a homeowner board. Do you have any advice in how they can plan for bad debt? Is there a percentage of the budget or anything that you would say is good measure for a community that's trying to figure this out for the first time?
I think that's a question probably better suited for the in-house accounting person with castle management or whoever your manager may happen to be. Whatever it has been, it needs to go up is my main advice. And number two, keep in mind that the developer's trying to sell units. And so they're trying not to ruffle feathers. They don't necessarily want to get involved in a collection action or violation action unless they have to. So they're not going to be as quick to cite a violation as you would, or they need to be. Same way with the collection stuff. So whatever they've been spending on legal, you will need to increase that. And you also need to, it's developers deficit fund. So they're not paying assessments on all their units necessarily until they're built out. Maybe it depends on the wording in each set of governing documents. So they've probably budgeted very little for legal and for delinquencies. So you definitely want to. I don't have a rule of thumb. All I know is you're going to have to plan for more of it. And some of your seasoned accounting professionals within your management company will probably have a better idea of where to start you at. One other thing while we're thinking about it, look at your governing documents. Make sure that you have specific assessment rights for any pre-suit violation work you do, because your whole goal is going to be to recoup your legal fees and costs that you spend. The vast majority of the violations enforcement work that I do doesn't go to trial, and you don't have to spend that kind of money, but you still spend money sending the violation warning letters, the pre-arbitration warning letters, the pre-suit offer to mediate letters. All those things cost money. And if you don't have real clear rights in your governing documents to go back and assess that against the owner, then you want to shore that up via an amendment, because your goal should be to properly budget for your legal expenses, but also be able to recoup most of those throughout time. There are some things that you will never fully recoup all of it, but it's set up statutorily in your governing documents for you to be able to capture the vast majority of the fees and costs that you lay out for these actions.
Yeah. And going back to Gordon's question here regarding newly turned over communities, another thing to keep in mind with your assessments, and this is by no means taking any jabs at our developer friends. It's just the reality of it is, like George said, developers are in the business, they want to sell units. So of course they want to keep assessments low as well while they're selling units. And they provide deficit funding, and there's a lot of projects, especially depending on how long their build time has been, how many years the community has been in process of being built, that they'll cover the cost of those projects. So the reality is assessments more likely than not are going to go up, and they may go up a substantial amount after developer turnover, because the association is going to be responsible for more costs than they were when the developer was there. So that's something else to take into consideration is if you already have some delinquencies from the past, which, like George said, you should be able to kind of get from your prior financial statements that your management company should be willing to share with you, even if it was previously under developer control. They should be able to share that history with you to help you guys plan accordingly. But if you've already had some delinquencies and then your assessments are going to go up higher, of course you want to take that into consideration too, that those delinquencies are only going to probably be exacerbated by those higher new assessments.
And while we're on the subject of turnover, it's going to be, especially in light of what we saw in South Florida with the collapse of the condo in the last week, it's going to be important when you do turnover to do your own turnover studies. The developer typically does one as well, but you want to have your own folks come in and take a look at everything and make sure you're adequately reserving for all your maintenance responsibilities. That's very important, especially at turnover. And want to make sure you get all the proper documents from your developer, including any warranties on any common area, things that you're responsible for maintaining, contracts, all those type of things. You want to make sure that the statute lit has a whole laundry list of things that have to be turned over. You're going to want to make sure you get all those, and just take a look at your financials, make sure everything's in order, and make sure your infrastructure is in order and you're heading in the right direction as far as reserving what you need to reserve to maintain those properly.
Yeah, absolutely. So we have about 15 minutes left for our allotted time that we had for this. And of course, this topic isn't something that necessarily needs to be drawn out into an hour. But does anybody have any further questions on topic of moratorium, of delinquencies, of policies, collection policies? And if they don't, I mean, George, if you're game for it, we can kind of just do a little open forum. If anybody has any just questions, we just have to, cut George some slack though, that he may not be prepared for a question that's answered. So keep that in mind.
My best shot.
But we can put him on fire here, and he'll give it his best shot. So if anybody has any just general legal questions at this point, or if you have any more questions that you've thought of that have to do with the actual topic of the webinar, please feel free to send them our way here, and we'll try to answer them for you. And then I'll give everybody a minute here to type, and then if not, we can just wrap up early too, which is fine. And like I mentioned, we will my colleague Laura and I, depending on where you are geographically and which office you fall under, we'll be sending out emails before the end of the week where we'll link this recording in case you want to share it or refer back to it. We didn't really have a PowerPoint presentation, so we won't be sending that this time. And we'll also send George's information out. So if you want to reach out to him, for further questions or for his services or whatever it might be, we will share his information as well. But I haven't seen any more questions come in, George. So I think everybody's happy at this point, or content at least. Oh wait, hold on. We had one come in. I didn't give enough time to type.
Before you answer that, you ask me that question, I would say one thing about budgets to be mindful of. Some of your budgets, whether it's in the statute or your governing documents, some of you are going to have budgetary caps on an annual basis that may only allow you to increase your budget a certain percentage each year. So you're going to have to pay attention to those. I have certain clients that are afraid to raise their assessments because they don't want to tick off the membership and get them angry with them for raising assessments. But if you know that you're not reserving properly or your budget's pretty tight, you may need to take it up to that ceiling every year to get where you're going. So don't be afraid to raise assessments and be mindful of the caps on annual raises of assessments.
Yeah, because if there is a cap, generally that requires a membership vote, correct, George? If it's above a certain percentage?
Membership votes are required to not fully fund reserves. Membership votes are required to exceed caps, assessment increase caps, that kind of thing. So, that's why I encourage you. Sometimes through voter apathy alone, it's tough to get the membership approval for those things. So one thing that's probably within your control is how much you can raise the periodic annual assessments from year to year. So be mindful of the cap, and you may want to take it up to the cap every year, especially this year in light of the increased expenses that you're going to face related to the moratorium being lifted.
Mm-hmm. So we got a question from Patricia. What power do homeowners have if the board does not collect interest and fees for late payments, even though their documents require it?
I have some colleagues out there across the state. I'm a member of some groups, if you will, fellow general counsel practitioners across the state. And there's some folks out there that believe the board has a fiduciary duty to collect every single dime they're entitled to with regard to interest, late fees, costs, everything. I'm not necessarily an adherent to that maxim. I think you need to tailor a policy that treats everybody equally, but you do have to take things on a case-by-case basis. And I find it hard to believe that a court would absolutely hammer you for making a few interest and late fee concessions to avoid a 100% debt write-off, bad debt write-off, because you pushed them into bankruptcy or foreclosure. The circumstances in every case are different. And I think you do have the power to make those concessions. And I do not think, number one, if a homeowner wanted to challenge the board's writing off of some late fees or interest to get a deal done, they would probably have to file a lawsuit. And, there's prevailing party attorney's fees. I just don't see a homeowner winning that lawsuit. I think, due to the business judgment rule and a myriad of other regulation, admin codes and cases, I think the association has some discretion to make some concessions. With regard to an association not charging the interest or late fees that they're entitled to in the governing documents, you're going to want to look very closely at the wording in the governing documents. Sometimes the language is permissive and it gives them the power to charge late fees and interest, but not necessarily make it mandatory. Whatever they end up doing with that regard, they should probably make that decision via policy or a resolution, have it in meeting minutes, agenda, that kind of thing. If you disagree with the way a board is handling a particular situation, sometimes, the best remedy is to run for the board yourself. I'm not sure that litigating the issue is the right path. You could certainly write to the board and let them know that, you think they need to charge late fees and interest, but your governing documents give direct guidance on it. So the board probably should follow what the governing documents say. And go from there. I know I kind of was very broad with that answer, but there's no one answer I can give because every set of governing documents is different on whether you're even allowed to charge late fees or interest and how much they are. You have statutory caps on interest, 18%, and late fees, $25 or 5% of the installment amount, but those are caps. Some of my governing documents have lower amounts. So even though statutorily you're allowed to charge 18% interest, in one association, its governing documents very clearly say that they've got a 6% cap. So it's definitely different from association to association.
Okay, perfect. And then one last question, and I think this one's kind of a tough one. I'm not sure there's really a right answer to this, but are there some best practices to be proactive and to mitigate the risk of rising delinquencies? I think that just kind of comes with the economy and what's going on and all of that, the job market. But do you have any best practices, George?
Well, just people got to have notice of it. And, you're going to want to constantly have your management company inspect property appraiser records and make sure your roster's up to date. Maybe send notices out to your owner saying, hey, if there's a change in contact information, let us know. Lack of notice is one of the reasons people don't pay. Inability is another reason. And so in your notices and reminder letters that you send out with your coupons, whatever else, you may want to put a blurb in there that lets them know, hey, if you have financial difficulties, please reach out to us. Don't ignore us, and remind them that the longer they ignore it, the greater chance they're going to have to pay late fees, interest, costs, attorney's fees. And so, I do encourage you to do some short-term payment plans and make a few concessions if it gets people paying. You certainly don't want to let them string you along and draw out the process too long, because the longer the non-payment goes on, the greater the chance is that you're going to have to write off some of that principal as bad debt, and that's what we're trying to avoid.
Yeah, and another best practice that kind of just came to mind, at least a best practice for Castle is, especially for those of you who do annual assessments or even biannual assessments, sometimes it's like, you said, George, the notice. So we've already started our budget season process at Castle. Our managers are already in June. They're already in the midst of creating their budget shells and getting that all, populated with information to be able to get their first draft over to their board or their finance committee, because we try to push our boards to have their budgets adopted by end of October, early November at the latest. We love to have as many of our budgets adopted in October as possible, because that gives time for those coupons to get generated and sent out. Because everybody, these banks, the companies producing these coupons are getting inundated that time of year, the end of year, December, especially. So the earlier that you can adopt your budget and get your coupons and your notice out to your owners, the more you're going to have, most likely paid on time. Because if you're sending your coupons out in December, you've got people traveling, you've got people out of town, and there's a good chance you're not going to have people paying on time for those January 1 assessments. So definitely plan accordingly with your budget process, and get that notice out and those coupons out to your owners sooner rather than later.
Absolutely.
All right. Well, we haven't had any other questions come in. I think we've covered everything. So thank you so much, George, for joining us today, for providing some information on what to expect and some best practices. We really appreciate it, as always. And if anybody out there comes up with a question, if you're anything like me, you'll think of a question like 2 hours from now that you wanted to ask. Feel free to reach out to myself, to George. If you want to jot it down, I've got George's information here on the screen right now, but we'll also email it out to you all before the end of the week as well. So thank you, everybody, for joining us. George, thank you. I hope everybody has a great rest of the week.
Thank you, Shauna. Thank you, everyone, for attending, and I appreciate the opportunity. Don't hesitate to reach out if you need anything.
Fantastic. Well, thank you so much. Everybody have a great day.